This week on the podcast, Scott and I are going to talk about, are we heading for a recession? Some of the GDP numbers, some of the big tech business earnings are coming out this week, and the market's still volatile. So let's get into it, talk about what is a recession and what should we be thinking about.
We've got some turbulence up ahead.
Hey, everybody, welcome into the podcast. Thanks for hanging out with Scott and I here on the Wealthy Pilots podcast as we talk about all this interesting stuff, Scott, that affects us no matter really what walk of life you're in, whether you're a pilot or not, right? I mean, there's all these things that are hitting us all. So how you doing this week, my friend?
Doing great. How about you, Mark?
Hanging in there. You know, we're just talking a little sports before we jumped on there. I'm a little hoarse today because a little double overtime win for my hockey team last night,
Nice.
Which was cool. Good to go see. A crazy atmosphere. We came down from 3-0 to win the game 5-4. So it was pretty wild.
Wow, that's awesome.
But the rockiness and the range of emotion was very similar to what people are going through right now with finance, right? Because we knew this was going to be an interesting week this week. So this is the final week of April. We are taping this, I think, on the last day of April, I think, actually.
It's kind of getting into the peak of earnings season here.
Yeah, earnings season. Thank you.
Yep.
And so some of the numbers are starting to come out and they're not looking great.
Yeah, I mean, I think, corporate earnings, right? You're seeing a mixed bag based off of some of the different sectors. But I think one of the biggest things that we're really seeing is for the first time since 2022, the economy had a shrinkage in GDP, gross domestic product, which basically means that the economy shrunk for the first time since we were in that little micro recession of 2022.
Correct.
So the markets aren't liking that news, but it's always important to kind of remember, like, the market tends to lead the economy. And so when we look at the tariff news that came out in the first part of the March and April timeframes, the market was really responding to that and starting to have a significant downward trend. And that was really starting to what we would say price in the risk of a recession. So a lot of times when people are responding to economic news, the market's way out in front of that. So, to me, it's a point of news out there, but it's not necessarily something that people need to go out and, drastically change their investment philosophy on, because we've already seen a lot of the pain from that come out here in the first quarter market performance.
Okay. And so what's the interpretation like? Because obviously all of the media is going to run with a lot of this stuff, right? Does that feed it? Does that make it a little worse? Does that change some of the conversation we've been having the last month while watching the volatility due to the tariff chats, right? Does that add more fuel to that when people think, well, okay, maybe do I need to do something? Do I need to change anything?
Well, there's a couple different schools of thoughts. I mean, first of all, news around recession. I mean, the news is going to have a frenzy with this. They're going to be excited to talk about how bad this is for everybody. And they're going to ignore that there's still many pockets of good news out there. One thing I think the Fed has a big challenge with here is we have this interesting environment where we have the economy shrinking and we have costs going up. That's what they call stagflation, where the economy is shrinking and we have inflation at the same time. And so, interest rates right now, the Fed's got a challenge in front of them if they're going to cut those rates, because, a rate cut will typically manifest in prices going up even higher. And so, that kind of backs the Fed into a little bit of a corner in terms of, hey, do we continue to strive for higher employment and potentially higher costs at the risk of growing the economy with inflation getting even worse, or do we hold rates where they're at and risk, the cost of capital not improving at all and risk putting the economy into a recession? So it's they're in a delicate spot, but I think ultimately, if we look, if we zoom out a little bit and look at where people have their money at, I mean, we're at record levels of number of cash on the sidelines right now. We got $7.2 trillion in cash on the sideline right now. So I think there are a lot of both retail and institutional investors that are waiting for this thing to settle down and get back in the market.
Well, we mentioned we mentioned kind of what is a recession, right? So, I mean, should we kind of maybe, kind of just give the basic overview on that?
Yeah, I mean, a recession is two back-to-back quarters where the economy shrinks.
Right.
And we have different levels of recessions. You have shallow or deep, let's say. So, you look at a 2008 financial crisis, and we got into a deep, deep recession.
Right.
And again, it's two back-to-back quarters of a shrinking economy.
Well, that's always up for debate too, right? Because the last time you mentioned 2022, they kind of tried to almost change the parameters. They were like, well, it seems like we're always playing a little revisionist history, but typically, yes, that has for the longest time been the standard, I think, for what considers a recession.
Yeah, 2022, there was a lot of discussion around, hey, we had a soft landing. We didn't have a recession, but we had two quarters. It was Q2, Q3. We had two quarters of back-to-back negative GDP.
Right.
We had that was a very shallow recession. And
it was shallow. That's a great point. But you have, again, the media, you have one side sitting there saying, no, it's totally fine. And that's not what it means. And then the other side saying that's exactly what it means. And so people just get all kinds of like, all right, what do I do? Like, what do I need to do here in this situation? So,
yeah, and I think too, again, it's one of those things where we want to zoom out and keep, as investors, we want to keep a long-term perspective. And so, what do I do in this scenario? It kind of depends on what's going on in your situation. If you're a younger person with, I don't know, let's say 5 to 30 years left to work, this is a little bit of just drive on, just drive on, keep saving, stick with your plan, et cetera. When you start getting inside of that 5-year window, especially the last couple of years of your career, it gets very delicate on making sure that we got enough, what I'll call safe money, built up on the sidelines.
Yeah.
And so, those last couple of years of your career and those first couple of years of retirement, the retirement red zone that we talk about, it's very, very important. If you're getting ready to retire this year and we do get into some recession that triggers some other economic issues that put us into a deeper recession, seeing market returns of negative 30, even negative up to negative 50 plus %, in Great Depression in 2001 and 2008, we had those over 50% drops in the market. If you incur one of those in the first couple of years of your retirement, you're going to have a very significantly different retirement than if you have something like that in the middle or end of your retirement. And so, and again, you've heard us talk about
sequence of risk return.
Exactly. Right? Sequence of returns. It's not just most people, when they plan their retirement, they just do their level 6 or 7% return for the rest of my life. And hey, my spreadsheet says I'm good. Well, they're not factoring in one, volatility of returns, which is what really happens. And then two, they're not factoring in the sequence. If I get those bad returns early in retirement compared to late, and I'm taking money out of the account, it's a significantly different amount of risk that's coming into my plan early in retirement.
Yeah, you're pulling out, the numbers are down, or you're just it's compounding the situation, right? Which is where the fear would come in. But I think that's really the very short term, right? That's if you're hitting retirement, or we're planning to hit retirement like this year, right? Folks that are still 5 years out or so, it's it's hard, but still maybe it's worthwhile pumping the brakes because you're not accessing that just yet.
Absolutely. Yeah. And even still, based off of your savings plan, where are you saving? There's a lot of times we might say, hey, if your 401k contributions are going in, just keep going into that equity component. And then if you got money going in the market outside in a different account, maybe those are the funds that we start to build up some of that money market or fixed income portion of our portfolio. Knowing that, hey, I'm going to be saving more conservatively over the next few years, but the assets I have, I want to keep that equity exposure because that's long-term money. And so you got to really look at what is the purpose of these accounts, these assets. Are these assets going to be for short-term income or for buying a house or buying a car or remodeling the kitchen or vacation? Probably don't want that in tech stocks, But if it's long-term money, let it do what long-term things are going to do. And again, recessions are part of normal, healthy, capitalistic economic activity. It is what it is. If we are going to be long-term equity investors and we're going to reap the benefits of, good, large company returns, then we got to be able to deal with the downturns.
Yeah. And it can't always be up, right? I mean, we get so easily lulled into that every single time it happens. I've been on this earth for 50 plus years and, for at least 30 watching this stuff. It's like every time we hit a cycle, right? It's almost the response is almost the same every single time,
Well, I mean, and it's easy.
It's human nature.
Well, and again, the market kind of trains that human nature too, right? Because it's up 80% of the time. And so 8 out of 10 years it's up, 8 out of 10 months it's up, 8 out of 10 weeks it's up. And so, most of the time the market is up. And so we like it when it's up. We don't like it when it's down. And so, it feeds into our natural desires to see it go up.
Yeah.
And then, when it comes down, we always, the phrase I always am coaching folks on trying to avoid because it will enter our psyche is, this time it's different.
Yeah.
Well, I always say this time it might be unique, but it's not different, right? The circumstances are always unique, but I would say it's really not different. There's some sort of news, some sort of issue that creates or triggers a market response and sometimes creates or triggers a recession. Yeah. Which creates and triggers more market responses. So, but that is generally what always happens. And what do we else know happens? We know that what always happens afterwards is
this too shall pass. If you want to go to the quote,
that's right. This too shall pass. But after it passes, well, actually, let me clarify that one point. Before it passes, because the market leads the economy, before the recession passes, the market rebounds every time. The market's going to rebound first. So if you're waiting for the all clear, you will miss the rebound. And so this is why market timing is very, very tough. So if we look back, right, I just pulled a couple of the historical ones recently here. Somebody who's retiring, let's say they're retiring this year. Let's go back to 1990. Okay. Mild recession, 20% downturn in the S&P 500. Once we bottomed out, market came back plus 30. All right. 2001 .com crash. Minus 50%. Once we bottomed out, comes back 34% after 1 year, and then it goes on a tear the next almost decade until the 2008 crash. So, great financial collapse, right? 08 to 09, 57% downturn, 1 year rebound plus 65%. And then here's the biggest one I think is fresh in everybody's mind too. 2020 COVID crash. 34% in a month we lost, and the 1 year rebound after that bottom plus 70. And so the rebound happens. It happens fast, and if you're waiting for the all clear, you'll miss it because the market leads the economy. That's the biggest takeaway I would leave people with, is that the market leads the economy. So if you're waiting for economic news to drive your decision making, you're too late. Which is why we would say you always want to have some market exposure. There's seasons to be a little bit more conservative, a little bit more aggressive. I agree.
Absolutely.
But trying to time the market, is not a good habit, and the data is very supportive of that. So,
well, we'll see who gets more pressure in this coming week or so. Whether it's the administration for, speeding up tariff chats, or if it's the feds for making any changes. We'll see how that plays out with the numbers. And of course, if you need help with your numbers, please reach out to Scott and have a conversation. Get yourself onto his calendar. You can find the information in the show links below. Go to retireairlines.com. He is the airline advisor. And if you need some help, again, just click on the link, get some time onto his calendar. Don't forget to subscribe to us as well on Apple, Spotify, and YouTube. Scott, thanks for breaking it down as always, my friend. I'll see you next week.
See you soon.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.